We're talking this morning about people with investment portfolios with certain investment or financial institutions in the country. Several individuals have received releases from their bankers or their investment firms, or making suggestions as to how they must handle their investments with them. They say, if you withdraw now, it will be at a certain rate. They say, if you keep it with us for a while, when we've been able to weather the storm, we can guarantee you that your interests, your principal will be safeguarded. There have been concerns, especially with the assurance which has come from His Excellency the President, that there will be no haircut when it comes to the investments of people in the country. And yet, people are afraid, people are concerned about these releases they are getting. The Securities and Exchange Commission also put out a statement. I would like to share with you some headline I saw from Daily Graphic after it put out its release, and people started raising concerns that this was a backdoor approach to haircutting people's investments. Now, the headline of the story says, SEC directive not for haircut, Reverend Obami Tete. I'll read just a bit of it, and then I'll introduce my guest to you, and then we can begin the conversation. The Securities and Exchange Commission has allayed fears of the investing public, explaining that the objective of its latest directive on the use of fair value mark-to-market valuation method in valuing portfolios of collective investment schemes such as unit trusts and mutual funds was to provide consistency in the valuation of assets and portfolios in the securities industry. It said it was also to ensure that the portfolios reflect market values as well as investors of collective investment schemes. This is not a new valuation methodology. It is something that some of the market operators have been practicing, and we gave this directive because we want some uniformity in the marketplace. What the directive means is that if you are already using the methodology to value your stocks in your portfolio, you have your quantity versus the price. So what it means is that you want to see the market value of those securities that you have in your portfolio. So it shows the prevailing market prices of the securities. A senior manager at SEC, Anthony Dugbate, explained to Graphic Business. And so we would want to try and make sense of, these issues and what necessarily they mean, because not all of us have a better understanding and appreciation of the issues therein. Mr. Paul Abibio is Deputy Director General, Finance SEC, and Madame Eugenia Bashir is Managing Director, Tessa Capital, Member Governing Council of GSIA. Now, they would help me to try to have an understanding and appreciation of what the SEC directive was all about. Good morning, and thanks so much for joining me.
Good morning.
Good morning.
I will start with you, Mr. Abibio.
Sure.
What prompted the release from SEC?
Yeah, so we observed the current market environment. And as you know, in Ghana, we have a fixed income market where fixed income securities trade. After the initial issuance, there's trading. So people buy and sell these securities all the time. Now, as a result of that, when interest rates rise, sometimes the prices of securities fall. And when you need to sell a security, you would have to sell at the market price. And so what has happened is that in the current environment, we've seen that one, there's liquidity issues in the secondary market, and then the high rates have also led to clients also seeking redemptions. We've seen people increasing their level of redemptions. Now this is forcing fund managers to sell assets. And when you are selling assets, there's a price for those assets, and you have to pay that price. You cannot sell at the price that you keep in your books. So we came out with this directive to ensure that, one, there's consistency in how people are keeping their books. Because if the document or the asset you are holding has a reference price, then you should mark your market to that reference price. So our directive is to ensure that these securities in the past, they were being held to maturity. So say somebody buys a bond, and he assumes that, okay, I'm going to hold the bond for the next 5 years. So he'll keep it. In 5 years' time, you get the 100 cedis on the bond. But if you sell after 2 years, the price will be based on the current interest rate environment you're facing. What we view is that for collective investment schemes, they are obliged to meet investor redemptions when they come. So even though they may intend to hold the instrument to maturity, their model requires that they provide liquidity to investors at any point in time, which means that those securities should also be available for sale. But they are not intending to trade it. So the methodology we are using is the fair value through other comprehensive income, as opposed to fair value through profit and loss. So in the other comprehensive income, you mark it, but you haven't sold it yet. Until they sell it, that is when that loss or that gain is crystallized on their P&L. But on their books, they can keep changing the price to reflect the market dynamics. The other point is that at every point in time, people are also buying the shares in the schemes. So when somebody comes to buy the share, the price of the scheme is determined by the underlying assets. They are buying a participation right in the underlying assets. So it has to be priced so that they get a fair value on what they are buying. Right? So that was what informed this directive.
Interesting. I would have thought that this would be obvious enough to the institutions trading, seeing that if I get you, the customer, the client, whose investments are with these institutions, obviously must be told by the institution, but at the prevailing rate, if you decide to call back your investment with us, this rate which we had agreed was going to be the rate at which we are going to give you this. It's not going to happen. And so this should be a regular methodology that by this time most of the institutions should be adhering to. Should that not be the case? Should that not be the obvious?
Well, I think it's also about the maturity of the market. The fixed income market itself is just about 6 years old. In the past, when you bought Government of Ghana bills, you only go to your bank to rediscount. And whatever price the bank gives you is the price you pay. And so some of the schemes managed it by having a portion of their assets in short-term securities that are often maturing in the near term for liquidity purposes. Then the rest of the portfolio would be held in long-term securities. But with the increased depth of the market, you are finding different kinds of portfolios. So if somebody wants a short-term portfolio, he buys a short-term scheme. If he wants a long-term portfolio, he goes into a long-term scheme. And for the long-term schemes, this becomes very relevant because even though you may have a liquidity portion, the long-term portion of it has a lot more volatility. So that can affect the price. So I think it's part of the development of the market, and the current environment obviously makes it more imperative that those prices are reflected. And to address the point you made about the redemption, the way a collective investment scheme works, there's no maturity as an investor. So there are two sides of it. There's the underlying portfolio, which will have a maturity date. Each of the investments they buy, if it's a fixed income instrument, will have a maturity date. But the investor who goes into a scheme, there's no maturity date. They become a shareholder of the entire portfolio. So it's not like you go in and say, okay, 30 days, I'm coming out. It's 30 days, I want to redeem. And when you redeem, the investment scheme will sell assets to get liquidity for you. Sometimes they may hold some cash. Sometimes they may have to sell assets. So that's the dynamics around it. So they're actually participating in the entire portfolio. It's not like a fixed direct. You can buy the treasury bills directly. But even now, if you buy it, you'll see that when you want to redeem before maturity, you'll face the market price. And so that is what we are also reflecting in these scheme portfolios. So
since the issuance of that release, or that, how has been compliance?
Some firms are actually already practicing this, as you've said. And some have a hybrid version, because if you have a segment that is strictly market to market, but some segments you are holding to maturity, it's a hybrid form of compliance. We've engaged the industry players. Some are adjusting their software to enable them to comply, but they are also communicating to their clients about redemptions, because until they move there, redemptions would have to be at the current liquidation value of the securities. So that is the dynamics around it. So I think we are seeing very high levels of compliance, and we expect that to be greater coming January next year.
Let's normalize the conversation, Eugenia, and let's try to make sense of the outlook in terms of investments, and whether it is even advisable for people to want to invest in some of these securities, bonds, and co. Would you say people should invest in these securities?
Yes, they definitely should. First of all, the industry is very well regulated, and that's why you're seeing some of the directives you're seeing now. It should tell you that SEC is up and doing, they are monitoring, they have the interest of investors at heart. So we want to assure investors that don't panic, don't be scared. Somebody's looking out for your interest, and that is what has necessitated some of these directives by SEC. Then what is happening in the market now is, if portfolios are being valued at fair value, at current market prices, and the market is such that you're seeing some of these values are so low, this is the time to get in. If you have excess liquidity, this is the time to buy. When the market corrects, you see the values going up, and then you gain from these investments you have done. Those who are rushing to withdraw, don't panic. We understand it's not easy to come by money these days. You have worked, you have earned your money, you've been able to put some aside to invest. Congratulations, that's great. Take the next step. Don't panic. Don't lose what you have worked so hard to save now. It's a market circumstance we are going through. It would pass, and we'll start seeing the stability we saw some time ago. So don't rush now. If you don't need the money, this is the time. Leave it in, okay? And then over time, it will correct. As Paul said, you've invested in a collective investment scheme. It has a pool of different assets. So in the past, maybe most of the assets were at the low coupon rate. But as fund managers, as new instruments are coming in the market, as the instruments in the portfolio are maturing, we are changing. We are buying some of the new ones. So over time, you find that if you all don't panic, the return on the portfolio will reflect what is on the market. So this is not the time to rush in to start redeeming your investment. If you have funds, this is the time to invest.
It's interesting that you'd encourage people to buy now with the panic withdrawals that is going on in the country. But I'm asking myself the question, really, we don't know when this is going to end, because it's not as if we have gotten out of COVID-19. It's not as if we know when the Russia-Ukraine war is going to end. It's not as if we know when the North Korea, South Korea issues are going to also escalate. It's not as if we know when the US and China issue is going to also go out of gear. And so these are all things that affect the market in terms of forecasting. And so if I am following the market, obviously, I wouldn't be that enthused to want to invest now, would I?
You're absolutely right. There are uncertainties in the economy. But what's the alternative? You keep the money in the bank account. Inflation is rising every day. And so what is happening to the value of your money? It's depreciating by the day. By it sitting in your bank account not doing anything, you're losing value. But if you take the step to invest it, at least you stand a chance to be able to make something, to make up for the inflation that is eating away at your money. There's a lot of uncertainty. Our economists are working on it. I know there's a lot of talk about haircut and the fact that the haircut is already happening. Okay.
Is it already happening?
No.
Okay.
We have not been informed about any haircut. What is happening, as Paul explained, is the realities on the market. We are mostly invested in Government of Ghana securities, and the prices on these securities are changing. So as fund managers, we are just reflecting those prices in your portfolio. That is why you are seeing that drop in your value. Don't panic because your fund manager has sent you a statement and you have seen a drop in the value of your investment. You haven't realized it. There are realized gains and unrealized gains. If you don't go and withdraw, that value you see does not crystallize. You don't suffer that loss immediately. But if you leave it in and it travels and the fund manager continues to correct and rebalance the portfolio, you'll find that over time the portfolio will begin to reflect the current market prices.
You are experienced in the industry. I wouldn't kid myself to think that I know your business. I don't know your business. But you say that it's going to self-correct. How long do you envisage this self-correction is going to happen with experience and data?
Okay, so it will vary from portfolio to portfolio. It depends on what assets are in the portfolio of a particular fund manager. But over time, I'm sure if we had not had a lot of these panic withdrawals, you find that as new money comes in, as maturities happen, it wouldn't have taken too long for fund managers to correct. But now fund managers are having to use any little liquidity they have to pay off withdrawals. And so that would drag the correction process. But if we allow the markets to continue and we don't force the sort of withdrawals that are happening now, it wouldn't have taken a long time to correct. I can't sit here and say it would take 6 months, 1 year. No. It depends on what assets are in a particular portfolio and the time frame within which it will correct. Correct as in reflect the current yield on the market. Exactly.
Now, let me ask this, so that, because the point is always been about the protection of the interests of the, I would want to use the word client. Now, the exposure of most of these institutions are to the government of Ghana. And so if we are having this conversation and the exposure is the government of Ghana, the Securities and Exchange Commission, you are supposed to be partners with the Bank of Ghana, and you're supposed to be working with the Ministry of Finance. In that respect, since you're trying to give hope, what indications are there for you as SEC that the steps that the Bank of Ghana is taking indeed is going to bring about the self-correction we are talking about?
Well, for a start, you've seen the movements in the currency. Bank of Ghana has taken efforts to manage the rate of depreciation of the currency. That is one. Also to bring down inflation, because for investors, as Eugenia mentioned, they are struggling with inflation. Inflation eats away at your savings. Therefore, you require a higher rate of return on your investments. Now, what that means is that it increases the cost of capital for businesses, for the government to even finance development becomes quite expensive. So along with that, I mean, we are on 2 panels that have Bank of Ghana representatives.
Okay.
We're on the Financial Stability Council,
Okay.
where we discuss these matters of relevance, and we are looking at the long-term impact, bringing down rates to a sustainable level. And then we've also launched the Capital Market Master Plan, which also has Bank of Ghana representation on it. And that is about deepening the markets. Because if you have a shallow market, that is why government had to rely on foreign funding. But if you have a deep market that has adequate liquidity, then government can actually finance its operations from the local environment.
Okay.
So those are some of the measures we are taking to ensure that we have a sustainable debt market. We also need other corporate issuers. I mean, in this time of crisis, one should also ask, how are businesses funding their operations? A lot of businesses do bank loans, but bank loans now are quite expensive. And one might say this may not be the best time to issue bonds, but if you compare the debt market to a loan market, where you don't even have breathing room, it might be a better time to issue bonds to allow fund managers to diversify, because they also have to invest in what is on the market. And if they do an instrument that's not listed and they need to exit that position, they have to go back to the issuer and try and discount it. Now, if the issuer has invested in real assets, it's very hard for them to dispose of those assets to pay them back. But if it's a bond that has a secondary market, then the fund managers have time to even trade it amongst themselves, right? And that creates, I would say, a more sustainable financing mechanism for our businesses. So that's also an area that we are pushing hard on, encouraging local businesses along with the Ghana Stock Exchange to also come and issue securities. And as the point Eugenia made about the current environment, there's a philosophy in the financial markets that buy low, sell high. I mentioned that prices are low because of the high interest rate environment. It means that you can buy a security now at a discount, right? And these securities have a face value. So even though the market price now may be 70 cedis or 60 cedis, at maturity, it goes up to 100. And this is before you talk about coupon, because every 6 months, these instruments pay a coupon as well. So those are some of the dynamics at play. And it becomes an opportunity for businesses and for individuals who are savvy and have an opportunity to invest, this could also be a time to look at the market seriously and take some positions.
Now, let me read one of these notifications that one of these banks sent to one of their clients, and then you help me understand what that means. Now, it says that over the past, no, I want to skip a lot of it and then get to where the meat is. It says, to ensure protection to investors and comply with all regulatory directives and financial valuation standards, we wish to inform all unit holders that the valuation method for units held in our funds have been updated to the fair value valuation. This means that unit holders who wish to exit their investments will trigger their redemptions at the prices at which these bonds are presently worth on the market, which may currently result in losses in view of the current declining bond prices. It says that, however, investors that choose to remain in the fund until Ghana's macroeconomic health and bond prices improve are not likely to realize these losses. We wish to encourage all unit holders to remain in the fund in order to preserve value of the fund as new inflows and maturities are invested at current interest rate. There's a part where it talks about losses that even impact your principal, not even your interest, but your principal. I'm looking for that. But if I got this message from my financial institution or my investment firm, what does it mean?
I mean, a couple of things. As I mentioned, when they...
Sorry,
you've
I
got
found what I'm looking for. They say that these losses may impact the principal of the unit holder depending on how long they have been in the fund and prevailing bond prices. This is what I was looking for. But back to you.
Yeah. So a couple of things. One is obviously the need to tell people about the current environment and what is happening to investment securities. And that applies across board. It's not just the securities. Even other entities that hold government securities face this risk. The other dimension is that investments obviously have risk associated with it. One is the market price. There's also credit risk, the risk of a counterparty defaulting. There's also liquidity risk. So when I talked about listed securities often trade, so you have liquidity. Unlisted securities do not trade. So you could have a liquidity event. It may be that the counterparty has not defaulted, but does not have the liquidity to pay. Because maybe you agree that they'll pay you over 7 years, over 5 years. But you want your money after 1 year. At that point, if he only has 70 cedis to give you on your 100 cedis, you either take it or you leave the money there. Now, same for a collective investment scheme. When they've invested securities, those securities have a given maturity. Now, if there are heavy withdrawals, that means that they have to tap into securities they did not intend to sell. To liquidate those securities at the current environment, remember they have to liquidate them to pay people. So it means they have to go out there, sell those securities, realize whatever losses. There may be accumulated losses which are not realized. Until you sell it, you don't realize it. But once you sell it, you realize it. It could be a gain as well. And I will say that 3 years ago, the markets were the other way around. Instruments were actually priced high because the rates were low.
True.
So even though we are in the down market now, we also had an up market. And it moves in cycles, right? So what it means is that if you, and some of the schemes also have a time frame. If you withdraw before 3 years or before 2 years, one, there could be a penalty. But because of the prices as well, when you pull out, the price that is in the market is really what you would get. And that is what they are trying to communicate in that
Right.
message.
My time is far exhausted, but let me ask this. Any of you could pick it up. Is there a potential for a collapse of our market, of our system, seeing that most of these firms are exposed to the government, seeing that the government is waiting for us, for instance, to finish its negotiation with the IMF, hoping for some 3 billion that it's hoping to use to balance the economy? Is there a potential, if there's a delay in this conversation, between the government of Ghana and the IMF. Is that risk real?
That's a difficult one.
Yeah.
I think that government is working very hard, and from messaging that we've received, plans are quite far advanced. There are also other tools that are being brought to bear to deal with this kind of environment. This is obviously a very unusual kind of situation, but other countries have been through it and have come out of it. And so there's no reason why Ghana cannot work through this current situation. I would say that there have been situations where we've had quite difficult circumstances, and we've been able to work through it as a country. So I think we would be able to come out of
those
this
situations,
situation.
for instance, if you talk about the years of A, where banks filed for bankruptcy, entities that we all knew were firm on the ground suddenly were crumbling just like that. Is that a possibility here in a local context?
I don't think I can really conclude
Fair
on
enough.
that, but I
Fair
would say
enough.
that it is
Fair
highly
enough.
unlikely. Yeah.
Fair enough, fair enough. But I would like to thank you, Eugenia, for making time. I wish we had a longer time, if you don't mind, coming again, because this is a very sensitive matter that I believe we need to spend a lot more time to educate people.
Definitely.
And I think that on my part, I've been very unfair to my viewers and my listeners because we've had a very technical conversation. But I think that we should have broken it down if we had time, to make it much more easy to assimilate the issues we are discussing here, because we talk about securities, we talk about, but what are they?
What does it mean?
Yes,
But because of
yes.
time I don't have, we could not break these things down. But if
Okay.
we do have time and one of
Are we
these days
still
we
on
can
air?
have, yes, we're still on air.
Okay.
If we have an hour and you
Okay.
can come for us to break it down for people, I think it will go a long way to disabuse people's minds, to stop the panic withdrawals that people are doing
Yes.
with their investments. But I'm grateful that you joined me this morning.
Pleasure.
Thank you very much.
Thank you.
All right.